Good afternoon, everybody. My name is Bill Fukui. I'm with MedShark Digital, and I'll be the host for today's webinar panel. And we actually have a whole lineup of really good speakers, but also just some really good information. Today's course on preparing today for a successful transition tomorrow. I'm going to go ahead and start with introducing our first speaker, who is JoAnne Tanner. And a little background, and I've known JoAnne, for many years. We've actually, I've actually worked with some of her clients. And JoAnne she's a dental consultant, trainer, coach, just an extraordinary person when it comes to working with practices. She started her dental career in a really hands-on environment in the U.S. Navy as a dental technician. And again, I think she brings so much to practices, but also to their teams, and instilling this sense of enthusiasm and cohesiveness and harmony that we all know is the catalyst for a really successful practice. So the first part of the presentation, I'm going to let JoAnne take the reins and run with.
So welcome, everyone. After you finish dental school, you're trying to figure out, where do I want to go? You know you want to start your own practice, but where do I start? This is such a very important decision in your life. So location is very important. You need to decide, do I want to be downtown? Do I want to be in a rural area? But since COVID, that's also changed, because I want you to think about, where can I find teammates to work with me? Because you may want to live in the metropolitan city, for example, in San Francisco, but it's a little difficult to find some employees. So be very careful on making sure you understand, do I want to be in a professional building? Do I want to prefer to be in a retail center? Do I want to have a lease or a purchase? You need to contact a lot of people. Number one, the brokers. And by the way, you can email me. I'll send you a list of all the brokers. You need to make friends with each and every one of them. But think outside the box as well, because you may have friends in your dental society. I had a doctor, he had found one practice, he figured that was not a great fit. He says, what I'm going to do? I'm going to think outside the box like you told me, JoAnne, and I'm going to write the letter. He wrote a letter to the dentist from his dental society that they were age 55 and up. And do you know, he found a delightful practice, and he's just so excited about it. And then you may find an associate opportunity that may lead to ownership, because that's a great way to get to know exactly what you're getting. So doctors, when you go to buy a home, and by the way, that's probably one of the next biggest decisions in your life, you would never think about buying a home without a complete home inspection, right? And it's not going to be related to the broker of the home. When you go buy your practice, I want you to do a complete assessment. And that's what we're going to talk about today. Although it doesn't change the value of the practice, and our CPAs will speak to the value, I like to know, and I'm sure you'll want to know, how many active patients are there? I use the analogy about playing cards. When you're playing 21, are you getting to 21 in 2 cards, or did it take you 10 cards? You see, in dentistry, we need to know the mix of procedures and how many patients. So when we do the in-office chart audit, typically that's what the industry calls the process. It's truly about an entire practice assessment, including the treatment philosophy. How are they getting to that $800,000 or $1 million in production? The first thing we do when we're in the office is generate the pending treatment plan report, because I can scan that with our client and we get an idea of what size treatment plans are they diagnosing and what kind of inventory is still left to be done. And then together, and we know these are active patients, when we pull the chart, we actually look at the pending treatment, look at the x-rays and the intraoral photos. Now, I know we don't have the patient there to be able to compare, but you'll start to see a pattern. You'll start to understand and either agree or possibly disagree. Or maybe you'll see Gee, they're referring out a lot of endo. I know how to do endo. Good. So when you take a look at practice A, this practice was doing very well, collecting over $1 million. The active patients were also excellent, 1,500, and we're talking active patients in the practice, but true active, only 751 were there in the last 18 months. So if you take a look at this, they're doing a lot of production. Then conversely, practice B on the next slide, they have 761 true active patients, similar total active in the computer, but they only collected 416,000 because their production per patient is only 707. Let's see the next slide where we compare the two. And actually, the bottom slide, we call this a practice sleeper. Although it's not producing much, they have 700 active patients, but there's a lot of potential. And I don't necessarily want you to buy it on potential that they're going to be able to do $1 million. Ali will tell me, JoAnne, don't promise them they're going to do $1 million, but we know this practice has a great deal of potential. So in other words, you have to look at how do you get the numbers and how I need to get behind the numbers to truly understand what's going on. After we print the pending treatment plan report, we truly need to study long and hard the procedure code report. This procedure code report is going to tell us exactly what their types of procedures they're doing. How many crowns compared to the number of exams. Notice this practice is doing on average 40 crowns a month, but only 3 buildups. CPAs, now when you're looking at the delta, we'll talk about that in a moment, that's one of the ways they can make up the reduction because there are codes that maybe they're not billing out for. Taking a look at how much perio is going on in the practice, and if there's not much, I caution you, do not implement that right away because that patient's been going to their friend, the dentist, for 20 or 30 years. And here comes the younger doctor in there. So that's something you can do, but please, not right away. So again, this tells us a great deal of what's going on in the practice and how many active patients. This is a report that we provide for our clients about the Delta Dental. In many states, especially in California, every time a doctor buys a practice or starts a second location, if the seller is in network with Delta, and the seller most likely will be Premier, the new doctor must take the Delta PPO or go out of network. However, we need to know how many patients are in the Delta Dental. But this first report we put together based on the codes that the Delta patients are doing. If the practice has Dentrix, Eagle Soft, and Open Dental, we have an app that gives us all this data. And it's extremely helpful because we can tell how many prophies, how many crowns, and all the perio that's going on. So we can actually forecast that drop in revenue. This is another practice that they did 900 prophies plus, 53 crowns, only 2 buildups. Doctors, you're already seeing some opportunities here. But look closely at the fees for the fillings. We do a lot of fillings, a lot of restorations. The fees, unfortunately, are 40 to 45% fee reduction. So that's important to note. The crowns, it depends upon where the seller's crown is. Recently, Brett and I had a mutual client. The seller's crown fee was only $900. They're not billing out the crown buildup that often. So between that, it wasn't that much of a reduction taking the Delta PPO. So you say, how much Delta? A number of times the seller or the broker's package, they'll give us the Delta 1099. Now, doctors, that only tells you part of the story. The Delta 1099 tells us how much did Delta pay, not the patient portion. For example, the practice collected $1 million and the seller said, here's my 1099. It's $247,000. So Delta's 25%. No, it's not. Next slide. The delta is more than that because we have the patient copay that came into that $1 million of production. The $247,000 was only what Delta paid. When we ran our app and told us exactly how much Delta from the PPO wizard of the insurance patients, 58%, but of the total patients, it was 47, nearly double than what they had estimated. So it's really important that we're able to run that. So in addition to understanding the treatment philosophy, in addition to understanding the delta and all the procedure codes that the seller is doing, if it looks good and then you decide to move to the next level, we look at the management systems. Now you might say, JoAnne, accounts receivables, I may not buy the AR. However, what you are buying is a system in place where the doctor seller could afford to give the patient 6 or 8 months to pay. The seller was having different financial policies that maybe you can afford to provide. In addition, you need to look at the AR credits. The AR credits are a liability that either the doctor has received money prepaid, or they have collected maybe an extra $50 there, $150 there. It could be a few thousand, but in this particular office, it was $72,000 because this practice has never gone through the auditing of paying back the AR credits. So it's a liability. And if the seller doesn't address that, the patient comes back in, and if they expect that money, then it's going to look poorly upon the buyer. So accounts receivables are an important part. The next item has to do with closing the month end, which is amazingly important. You say, well, what does that have to do with it? If you don't close out the computer, let's say in the month of October, if I don't run a month end, and I start posting November, yes, you'll still get October production, November production, but the accounts receivables do not age. The AR thinks I'm still back in October. It still shows up as current. This is huge when you go by the accounts receivables. So my dental billing specialist, Katrina Winch, has been on the Zoom with me many times to help me look to see have they closed out the month end, because if they haven't, then that AR report isn't accurate. Yes. So in addition to understanding what am I getting, and we work closely with our clients on telling you where are some opportunities. Maybe there's some profit leaks in the practice. For example, they may be getting 10 new patients, but they're losing. They're not keeping track. They need a better recall reminder system. When we closed down for COVID, so many of the practices turned off their reminders and they forgot to turn back on for past due patients. So that's an opportunity for us. So after we look at all the opportunities, we also take a look at, are they pre-appointing? This one particular seller said, absolutely, 80 to 90%. And as you'll notice on the next slide, when we ran our app, we were able to find out they're only 53%. It's not a make or break, but I want you to know now the system isn't working rather than waiting 6 months to figure out, so you know right away to start pre-appointing for the hygiene. Then we put together a strategic action plan, knowing the strengths of the practice, where are the weaknesses, maybe there's some opportunities and threats. When I did my master's program, strategic planning was my emphasis, and this is really fun to help our clients to see what can I do with this practice. Lastly, in addition to understanding the treatment philosophy, my patients, you need to have a thorough inspection of the IT. Your computer needs to be inspected. True story, we found out that a doctor was working off of Windows XP. Well, because that's no longer supported, technically, that's not HIPAA compliant. Most recently, we found one server was in great shape, and that's good to know. Then when you have your equipment inspected, making sure that the HVAC, all the sterilizers are working. And we're able to accommodate all that. And we have recommendations on that. Great. Thank you, everyone. Any questions so far?
I didn't get any chat questions. Actually, I take that back. I got a question that says, can you let us know who would pay for the inspections? Who pays for those?
In Northern California, I have a contact that does a complimentary IT inspection.
Oh, okay. Do most practices though? Do most practices, if you don't use them, how do most of those practices do they have to pay for some?
I have a connection that the IT inspection is included. Occasionally there is a fee for the equipment inspection, but we do have a lot of resources. Good question.
Okay, great.
No, the buyer.
If there is a cost for that inspection, would that be a buyer's expense?
I'm actually going to ask Ali. I'm going to do phone a friend because I think it would be negotiated. The buyer wants it, so I would think it would be the buyer, but I'm going to ask my good friend, the attorney, to help me answer that one.
Yeah, that's right. I think the inspection should be the buyer's expense, and they should want it to be their expense, quite honestly, because then the inspector is working for them as opposed to working for the seller. But I think, as you said, JoAnne, there are a lot of really good people out there who will do it either complimentary or for a small fee, and that's what you want. I mean, you want somebody honest who will do it and give you an honest assessment of exactly what's going on, both on the equipment side and also on the computer side, IT side.
Yeah, I think the comment was loyalty to the person that pays the bill.
That's right. That's right.
I think that's pretty appropriate. Well, our next speaker, I'm going to go ahead and introduce very quickly Ali, who's already somewhat jumped in here already. He is actually one of the nation's leading dental lawyers, and he's the founder of Dental and Medical Counsel, which is really a preeminent law firm that specializes in dentistry and dental, entrepreneurs. And his expertise really is in what we're talking about today, which is going to be, practice acquisitions, startup sales, even to the level of corporate, partnerships, associate contracts, employment law. So he pretty much knows everything there is to know about this. So I'm going to go ahead and let Ali start.
Well, welcome everyone. This is my topic is on the legal side, of course, of how to purchase or sell a dental practice correctly. We're going to get into a lot of material. I won't go through the introductions because, as Bill did so eloquently, this is all I do. I'm a dental lawyer, so I help all of you with the practice acquisition side or startup side. Obviously, we do this exclusively for buyers and sellers, and so don't hesitate to ask questions tonight. So the way this sort of process works when you're buying or selling, really, there's a couple of documents that are really, really important, and it really starts with the letter of intent, which is the document that sets out the terms of what it is that you are buying, how much you're going to pay for it, when you're going to close, are you going to work back, or do you want the seller to work back, how much are you going to pay for it, what's going to happen with accounts receivables. So it's really an important document, and some people kind of ignore it and pretend or believe it to just be sort of another kind of thing that you do, but not really put a lot of emphasis on it. And that is a mistake. It's a mistake because everything in the letter of intent transfers over to the asset purchase agreement. You don't really get another opportunity to renegotiate it. Now, the reality is that if you do sign a letter of intent or you submit a letter of intent and then the data on which you based your decisions on changes or proves to be inaccurate, then of course you can go back and change the price of the practice or other things. But typically, what the brokers or what the sellers tell you is their revenue and their new patients and all this tends to be accurate. And so So when you submit a letter of intent, you got to be comfortable knowing that that is the price that I'm going to pay, and this is what I'm going to do, and this is what I'm committing to long term. Once that's done, it's going to the asset purchase agreement, which is the main legal document that governs the purchase of the practice. This is where we spend a lot of time negotiating with the seller and the seller's attorney. This is actually a pretty smooth process, especially if you're using one of the brokers here in the Bay Area. There's a lot of good ones, but their contracts are pretty solid, and we go back and forth with the sellers depending on sort of what's important to them. But that asset purchase agreement, hugely important. The exhibits are also important, and people ignore the exhibits usually because they think, oh, it's just like whatever, it's just an equipment list or whatnot. And I can tell you from experience that these equipment lists and other exhibits are very important, because if you walk in through an office and you see a CEREC machine, for example, and then that CEREC machine is not on that equipment list that you're buying, well, guess what? You're expecting something and you're not getting it. And so that is a big deal. And we have seen that, and we see that every once in a while, where somebody will try to take a piece of equipment out of the practice and sell it on the side or whatnot. So just make sure the exhibits are there, make sure the list of the family members are accurate, the list of contracts that you're supposed to take over as the buyer is accurate. Then the lease assignment there, you're going to most likely take over the lease for the seller. And so you need an assignment of the lease. Sometimes we negotiate a brand new lease depending on how much term is left. But again, that's a hugely important document. It's probably the single most expensive investment you'll make outside of your home when you buy a practice. And so it's really important that you make sure your investment is secured with a strong lease. And if the seller is going to work back for you as the buyer, then you'll need an associate agreement, of course, that details everything there. So just kind of keep that in mind. Can I go to the next screen? There we go. All right. So the decision now, there is no wrong decision whether you're gonna buy or let's say do a startup. The only wrong decision, honestly, is not making a decision, right? Because what we know is that you cannot get to financial independence working, for someone else when you have $300,000, $400,000, $500,000, $600,000 of student debt. We have, we just, a couple of years ago saw our first dental client with over $900,000 of student debt. And so that is a massive, massive amount of debt. And so you want to be a practice owner, you want to, control your own life in that sense. And so it's very, very important that you make the decision to become an entrepreneur and own your own practice and start building from there. It's been done, it's been proven, you work with the right advisors, you're going to do great. And so not doing anything is really much, much worse than taking the jump and becoming an owner. But of course, doing it the right way with the right advisors and the right strategies is the key. All right, let's go into some of the legal basics of what you should be looking out for. And we won't go into too much detail in some of this stuff, but I do want to go through some of the more important things. The first thing is what's called a restricted covenant. Now, most of you know restricted covenants in employment agreements here in California are totally illegal. It's been compared to slavery, so you can't have that. But when you're buying someone's practice, when you're buying someone's business and their goodwill, you can restrict them from competing against you, which makes sense when you think about it, because we don't want people to sell their businesses and then walk down the street and open up another dental practice and take all the patients back. That would be the most silly thing if the law allowed that. So you want to make sure that you get a good, strong restricted covenant. 5 years is very normal, and anywhere from 10 to 25 miles is reasonable. If you're in downtown San Francisco, 10 miles is probably a good number for you, if not even maybe 5 miles. If you're in the East Bay, South Bay, other areas, then you could have 15, 20, 25 miles. And the idea there is to protect against patients, somebody opening up, the seller opening up down the street and taking those patients back, of course. So the bigger their reach, the bigger the covenant should be. All right. And so just kind of keep that in mind as you kind of think about the restricted covenant. Now, the allocation of the purchase price, Brett and Quinn will go probably through some of this, but I can tell you this is always funny to me because, buyers get really bent out of shape over the allocation of the purchase price. And what I can tell you is that there is a significant tax consequence to the sellers, but very little tax consequence to you long term with regard to the allocation of the purchase price. So and the difference really is about, why did it go forward? I didn't click anything. It's got a mind of its own. It's alive. Okay, so the allocation of the purchase price, there's about a 20% difference, up to a 20% difference in tax that the seller will pay if this thing is not allocated, correctly. And so you've got to be careful with this. Buyers, don't lose, your mind over it. It's important to negotiate it, but you don't want to lose the deal over the allocation. The typical range is 80% goes to intangibles and 20% goes to tangibles, right? So when you're differentiating the assets and how much value you're going to attach to each, 80% usually plus or minus, 10% goes to intangibles, and 20% plus or minus 10%, goes to tangibles. Now, the reason you don't want to go 100% to zero is because the IRS is going to come call it, right? And in 15 years of doing this, I can tell you that the only times my clients have been audited, literally the only times, is when they mess around with this and they go below 10% on tangible assets. I don't know if it's a dirty dozen rule at the IRS or a huge red flag, but what I can tell you is that they do flag it, because in a couple of occasions where that has happened, those people have been audited. And so I always say, do not go below 10% on tangible. And this is good for you as a seller and you as the buyers in the room. So just kind of keep that in mind. But you need a good CPA to be able to help you with it. So that's why these guys are on this seminar tonight. And they're some of the best. All right, so now accounts receivables. Well, with accounts receivables, typically the way it works is we tell our clients, the buyers, do not buy the seller's accounts receivables. Instead, go ahead and collect their accounts receivables for them. And so typically anywhere from 90 days to 180 days after closing, you will collect, as the buyer, the seller's accounts receivable. For all that hard work that you're going to do, the seller is going to pay you 5% of what you collect, right? 5% of what you collect. And that covers the cost of the employees, postage, stamps, envelopes, all that kind of good stuff. And so that's a pretty accepted, kind of process. Sometimes we'll get sellers who say, you know what, I want to collect it myself, and that's totally fine. What I would recommend to all of you buyers on today's call is make sure that there's language in your contract where the seller cannot send those patients to either small claims court or collections, right? Or collections. And the reason is because that's your goodwill. That's what you bought, right? And so the last thing you want is the seller to be taking your patients to small claims court, because guess who they're going to take it out on? They're going to take it out on you, right? They're going to take it out on you. They're going to take it out on you on Yelp or any, sort of public domain, because they don't understand what's happened, really. They know that you've taken over the practice. They don't really care, right? And so they're going to try to bash you. And we've seen that, sadly, a bunch of times. And so just kind of be careful. All right, step 2, when you're buying a practice, is don't ignore your HR. Please don't ignore it. The top lawsuit that we are seeing these days, pre-COVID and now especially during COVID, are HR lawsuits. And so there are 18 documents that you need to have as a buyer when you're hiring your employees for the first time. And these are the required ones. There's a ton more that are highly, highly recommended. So I strongly urge you to make sure you talk to HR for Health, and they'll get you set up. It's a super low costly monthly cost. They're endorsed by the CDA. So, they've been vetted and they're good to go. If you guys want a list of those 18 and some more details, just scan this QR code and it'll go to an article we wrote on this topic, and then you'll be able to, get that information. And if you don't have your phone handy or whatnot, we can always send it to you later. All right, due diligence. Now, due diligence means you're going to do your homework before you buy a practice. And there's three kinds of due diligences. The first is financial due diligence, right? Financial due diligence is you have your CPA and the bank looking at the tax returns, the P&Ls, the profit and losses. You know, they're looking at the balance sheet. They're looking at the entire kind of financial component of the practice that they can get their hands on, right? So super, super important to look at this. And if you've got a good, strong dental CPA, they will be able to spot things that most other people will not spot. Like, for example, why are your supply costs here super low compared to your production? Well, maybe the seller has a couple practices and he's monkeying around with the, with the expenses. You got to know that, right? You got to know that. Or wow, we see numbers, that show that there's, 8 hygiene days a week, but we're only paying one hygienist, on payroll. Like, what's going on? So those details are the kind of details you need to know. Financial due diligence, hugely important, especially when it comes to, things that you just would not normally see in your normal day-to-day. Legal due diligence, that's my part, of course, contract review, setting up your corporation, hiring your employees. That's what I do. We'll do this, all day long, of course, for you. Finally, the practice management due diligence. And this is, by the way, this is all my terminology, right? So other people have different words for them. But for me, the practice management due diligence side is hugely important, because if you get a trusted consultant like JoAnne involved, what you're going to see is that they're going to do an analysis for you, whereby you will know exactly not only what's kind of good about the practice, but more importantly, where are the opportunities for you to thrive after you've purchased this. So you don't want to share this report with the seller. You want to take this data and say, all right, where are my opportunities? I'm going to buy this and I'm going to pay $700,000 for it. But what can I do to make that $800,000, $900,000? And JoAnne and her data are going to be able to tell you that. So it's the equivalent of taking your used car to a mechanic, where they tell you all the things that are good and bad about it. You need to have this. And I would say 75% of our clients, do this every time they buy a practice. So I feel, really lucky that they do, because it minimizes the risk of failure and minimizes the chance that something unexpected is going to be found out down the road after the practice has been bought. So super important. Before we started teaching about practice management due diligence, before we started kind of putting it out in the world through my articles and videos and all that stuff, I would say 15%, if not less, of people were actually doing the third due diligence. They were just doing the financial and the legal. They weren't really focusing on the third side. And so it's super important for you all to do that, because that is the way you minimize your risk. And that's what this is all about. Minimizing liability and minimizing risk, whether it's HR, practice management, tax, whatever or whatnot. Consider an office makeover. I don't recommend this in the first year, but after the first year, do an awesome, makeover, new paint, carpet, whatever. It really, really helps kind of re-energize the office, increases its value. Our clients have sometimes said that, treatment plan acceptance goes through the roof when the office just looks fresh and new, whether that's with technology or something simple as a makeover. So something I'd like to put in there. The leases, are, like I mentioned, really super complex, in the sense that there's a lot of liability that exists here. There's kind of some misinformation out there that because of COVID, landlords are desperate, and that because of that, you can get screaming deals. What I can tell you is that if you're an office user and you're in downtown San Francisco, the answer is yes. If you're a dentist in California or in the Bay Area, more specifically, it's hard. Landlords know it's hard for you to move. They're still keeping their rents pretty high. You can still negotiate pretty good deals, but they're not going to be screaming deals. The goal, I think, is to hire a really good, strong commercial broker that specializes in medical and dental, and let them kind of negotiate these terms for you, because they are going to do a really great job of getting you the lowest rates and some free money and whatnot. But you have to be super, super careful when it comes to the leases, because if you don't, and you don't know the kind of lease that you're getting into, it could cost you thousands of dollars. And so just to kind of quickly tell you the two types of leases out there, one's called a triple net lease, and it uses the moniker of NNN. So you might see some place where it says $2 a square foot, NNN. That basically means that you will pay your fair share of everything with regard to this building. They want to change a light bulb, you'll pay your fair share of that. If it's your, the parking lot, the roof, you pay your fair share. It's by far the worst kind of lease to have, but as you can imagine, it's the most common kind of lease that you will find. So don't walk away from a practice that you want to buy or a space because of this, but it just means you got to negotiate it a little bit better. A full service lease is the best kind of lease. And as you can imagine, it's the least common because it's not as good for the landlords. But basically here is you pay rent and you pay for nothing else really other than your own utilities. So if you can get your hands on those, then amazing. If you're a seller on today's webinar, make sure you know when your lease ends, very important so that you don't run against that timeline and you can get kicked out. I have someone right now in Fremont who is out of their lease, they're month to month, and the landlord's threatening to kick them out while they're in the middle of trying to sell their practice. So really, really crazy. You don't want to be in that situation. Okay, so what are the risks and what are the opportunities? Well, as we've talked about, the risks and opportunities here are what are you willing to do to minimize your risk so that you can maximize your opportunity when you become an entrepreneur. And the goal here, of course, is risk minimization, and while at the same time increasing your opportunities. And so the things we've talked about kind of fall into that category. Now, today's goal, we each have about 20 minutes to speak. We wanted to keep this short and sweet for you. So none of you are going to become dental lawyers after tonight, but the goal is for you to raise your hand and say, you know what, Ali said some really interesting things, and I want to learn more about that. So I'm going to contact him. Or you know what, I want to contact JoAnne and learn more about what it means to do practice management due diligence. What does Ali mean about that? Or I'm going to contact Quentin. Don't contact Brett. Just contact Quentin. No, I'm just joking. You contact Brett or Quentin and say, hey, what is this financial due diligence that Ali is talking about? Tell me more. Like, what are you looking at? How can you help me? Get your transition team ready, right? Because I'll tell you, the brokers care about that. If you got a good team, right? You got a good lawyer, you got a good CPA, a good consultant, you got a good, bankers, lenders, they will respect you more and they'll help you find a good practice. Make sure you get pre-approved with one of the lenders. There's a couple of them that are really, really good right now. If you want their names, let me know, just email me. I'm happy to give them to you. They're not all made equal. So you want to make sure that you hang your hat on a good one. If you're going to buy a real estate, there are some really, really good banks that do good SBA loans. So let me know. And then don't forget about due diligence. I know we talked about it a lot tonight. Please, please, please don't forget about due diligence, right? I am a true believer in that. And so if you work with me, I'll make sure you do it and you're working with a great team, but don't forget about it. So as we end, or my portion ends, what's the moment of truth, right? Well, the moment of truth is very simple. What are you going to do next, right? What are you going to do next? Because you're listening to all this and you're taking it in. It's super fast. You're going to raise your hand and ask for help, but what are you going to do next? And that's where it gets to be super exciting, because the next steps for you should be, all right, I'm going to make the decision to start looking for a practice, or I'm going to start to make the decision of selling a practice. And I've got 2 great articles and white papers that I've written on this topic. If you want to buy, take a picture of the QR code on the right and you'll get my article in your email. If you want to sell, do the QR code on the left and you'll get some content about that, about how to sell properly. And of course, everyone, please, the reason we do this is so that you reach out to us and you talk to us and ask your questions. So, please feel free to do that. I don't know if the slides are, there we go. There's my email and my phone number. So don't hesitate to reach out. That's what we're here for. So thank you guys. I can't believe I did it in 23 minutes, but I appreciate being able to do it. So.
If you can go ahead and pass the host control over to Brett.
Done.
And then actually there was 2 private chats that I got. One of them was, what are the tax ramifications of a purchase? I'm not sure if the detail, if you can answer that, but that is,
I'll probably hang.
what are,
I'll probably hand that baton off to Brett and Quentin on the tax ramifications of it. But yeah, there's a lot depending on whether you're a buyer or a seller. Yeah.
okay. And
Yeah.
the other question was on the legal entity, and what the question was, what legal entity should I establish when purchasing a practice?
Yeah, great question. So in California, it's super simple. You should be a corporation because that's all you can be, and you can't be an LLC, unlike despite what some of the online services say. And a lot of young dentists make the mistake of going to I don't know, LegalZoom or some of these like nonsensical like websites, and they sort of set up their own corporations. Well, those are not meant for professionals, right? They are meant for dry cleaners and laundromats and like stamp collectors, right? They're not meant for you. Just like you should not be listening to Susie Orman's, financial advice, right? You should be talking to like a real financial advisor because it's not about saving $2 on Starbucks coffee to become financially independent, right? So right. They're not meant for you, right? And so California is super easy. Make a corporation. Your only difficult decision is, should it be a C Corp or an S Corp? 95% of people pick an S Corp because it's single taxation, and Brett and Quentin can talk about that. But there are some changes with regard to even the corporation side that may impact that decision. But it's not proper to make a general statement about that because it depends on your specific scenario. So guys like Quentin and Brad and me can kind of walk you through that on an individual basis. So
that sounds great. Well, super. Well, I'd like to go ahead and introduce our next, actually two speakers. Brett is a principal over at Thomas Dahl, and he specializes in minimizing taxes through different strategies and planning, practice benchmarking, things like practice transition, buyer representations. And as Ollie was just talking about Susie Orman, he also works with practices in retirement planning. He holds a degree in accounting, but his real passion is really just helping practices reach that path towards financial freedom. And I found out later he just moved to Utah, I guess, and which is great because he's a big biking and Frisbee enthusiast. So Brett is our next speaker along with Quentin, and Quentin is he's a CPA and personal financial specialist over at Thomas Dahl as well. And he's been practicing in the Walnut Creek area for about 10 years. And I'm going to let you guys run with this. I don't want to take up any more of your presentation time.
Thanks so much for the introduction, Bill. Ali, excellent job. Lots of resources and content that's just so beneficial. JoAnne, I love JoAnne's profit leaks report that shows where the opportunities lie going into the practice. I just think that's so valuable, and it's just so crucial to surround yourself with a good team. So let's see here. There's Quentin's picture and his email there as well. If you don't want to hire me, that's okay. But make sure you hire a dental CPA who's working with you. So Thomas Dahl is one of the larger CPAs in the Bay Area. We work exclusively with over 1,000 dentists and specialists, at all stages of their careers. And there's a list of all the services. A lot of people think, I need a CPA. I need someone who can do my payroll. I need somebody that can help me decide to incorporate or not. Retirement plan solutions. We cover all those things. So like I said, if it's not me, you may want to look at these other resources. There's a lot of dental specific CPAs. And I've got a link to the webpage for the 80 CPA. That's the Academy of Dental CPAs. We're a member of that firm. I wanted to put a plug in for them as we represent over 10,000 dentists across the nation. So getting to that question that was asked on should I incorporate, I knew that was going to be asked. And so That's actually my first slide of content. I get this every time somebody's starting to look at a practice and starting to get, serious about buying. They come to me, Brett, hey, should I incorporate before I start, getting too far down the road? One thing that you need to keep in mind is called the QBI deduction. This is the qualified business income deduction. This started in 2018. It expires in 2025. The qualified business income deduction is basically a deduction it's a simple equation. It's 20% of whatever your business income is. So if you have a practice, your net income is 100K, you will literally get a $20,000 deduction on your personal tax return just for being a business owner. Now, the caveat for dentists is that you become ineligible for this deduction once your taxable income, this is not gross income, this is taxable. So after your deductions, if you're funding a retirement plan, it's after that. If you have a house and you have mortgage interest or you do charitable donations, all that stuff reduces your taxable income. So when your taxable income for a single individual hits 170 to 220, you start to phase out of that deduction at 170 if you're single, 340 if you're married. So, a lot of our single clients, they might be kind of over that threshold. I think more of our clients start to become eligible if they're buying a practice, they have a non-working spouse or a lower earning spouse. A lot of our clients can be eligible for this. If you incorporate, you have to pay yourself payroll, and that may impact your decision on if it makes sense for you to incorporate. So this is a big deduction. Like I said, for $100,000 of income, it could be $20,000. Double that if you double the income. It's a big deduction on the line. Just make sure you analyze the impacts of QBI, as it's one of the largest deductions you can get going into practice ownership. So all the other things that JoAnne talked about and Ali, you need to make sure that you go through those to make sure that the practice you're looking at is the right fit for you. And a lot of it comes down to just the type of dentistry performed. I get asked all the time, about the Delta Premier issue. Buyers want to quantify that, and they can do that by, JoAnne had that spreadsheet, the slide where it shows the PPO fees versus the Premier fees. By procedure, you're figuring out kind of ballpark where you're going to be in terms of a Delta Premier haircut is what I call it. You're taking a haircut off of your practice production if you're buying a Delta Premier practice. But at the end of the day, that number could be $50,000. It could be a $200,000 haircut. But at the end of the day, it really comes down to what's the dentistry being performed in the practice and getting a handle. Is there dentistry that can be brought in-house? Are there opportunities in the hygiene department and things, what's being referred out? What's the health of the practice, and can you offset that? So hopefully talking to, your team, you can kind of figure that out and help decide if it's the right practice for you. So with the buyer due diligence, as Ali said, there's three components. There's the management, there's the legal, there's the financial. And so specifically related to the financial due diligence of the practice, the first and foremost thing that we do is the price within a reasonable range, right? There's a lot of sellers out there. I mean, they have this emotional tie, I have to get $1 million for my practice, or 750 or whatever it is. And so we do check that, and I'll go into some more detail on how we determine that here in a bit. The cash flow of the practice, right? I'm okay if you're paying somewhat of a premium for a practice, if at the end of the day it can pay the bills, it can allow you to fund your retirement plan. If it puts you in a better situation than you're in being an associate, right? You're getting equity in your practice, you're making, hopefully more money, and on a better path to financial freedom. So the cash flow is really what we're focused on. That's what the banks are focused on as well. and they will certainly be there to help run cash flow reports and see kind of what's going to be your cash flow, not what the seller's is, but when you go in there and you're getting things in place, what is your cash flow after the debt service? I've got some things in here. So with the loan payment, usually the default is going to be a 10-year loan. But in some instances, especially with the Delta Premier practice, a lot of my clients have been leaning towards, taking on a longer term, right? A 12-year loan. Some lenders even would go out to 15. And if Delta Premier is a really big concern for you, it might help to stretch out those payments, give you a little bit of an extra buffer up front to be able to manage your cash flow. You can always pay those longer term loans off sooner, but that's certainly something to consider. So we take the projected collections of the practice. What is that going to be? If there is Delta Premier, can you offset that? So what's your collections going to be? Are you able to grow the practice with opportunities? And then we're subtracting out all of the overhead expenses, not including owner expenses, right? So if you're looking at practices, you're going to see the brokers do this. They will add back, they're called add backs. You're essentially adding back all of the owner benefits that they are taking and just looking at what the overhead will be prior to owner benefits. Once you get to that number, you'll subtract the loan payments. That's going to be your cash flow before taxes. And we have so many buyers that come to us. As Ali said, you've got your student loans, maybe you're trying to buy a house. Do you really want to take on another large loan? My answer is probably yes. I mean, it all comes down to cash flow. So we have a lot of buyers come to us that, just don't want to take on too much debt because they're afraid to be over leveraged. But if you just look at the numbers, I mean, it's like a night and day difference. So if we have two practices, a large one and a smaller one, 450,000 and 900,000 in collections, right? You're going to have your labs and supplies, your variable expenses. You're going to have your overhead. Usually in a larger practice, the overhead looks better, right? Because you have more revenue to spread out your fixed costs, like your rent and stuff, over more revenue. Your loan payment, obviously, in the larger practice is going to be larger. In this one, it's about a $60,000 difference. But at the end of the day, could be the difference in $120,000 extra a year. I think it's well worth it, right? The lenders will finance that deal. We do have lots of clients who do go for the smaller size practices, and they do fine, right? But if you're really trying to leverage your staff and maximize your ability to produce, and ultimately your financial situation in the long term, it might be worth taking on that extra loan. Don't be afraid of it. So this is an example of our cash flow projection, and I'm sorry, the kind of the methodology for how we're assessing the reasonableness of the asking price, right? So you're going to have the net income on the tax returns. That's up at the very top here. This is net income on the tax returns. And then you're adding back. This is what the brokers do. They add back all of the owner benefits, right? Is there family on payroll? What's the owner's retirement plan look like? Are they funding that through the practice? Add all those things back, and you're going to get down to this adjusted net income line. And so for our analysis, we look at it on two methods, right? So we look at the top line. What are the collections of the practice? And it might be a range of 75 to 90%. I've got 80 to 90% on this one. But You've got the top line approach where you're just kind of getting a ballpark. We usually weight that lower. That's why the weight on this says 40%. We more heavily weight what the adjusted net income is of the practice. So most practices will sell somewhere around 2 times the adjusted net income of the practice. So that's this income down here after you do all of your add backs. You know, you're probably going to be around 2 times that number in what would be a reasonable price to pay. Now, are you going to pay more than that? Yeah, you might. The broker, especially if it's sold by a broker, they might be asking more than 2 times the adjusted net income of the practice. Well, that's fine if your cash flow and stuff line up, and it ends up being a good fit for you. So this slide, just going back to that point, like the value, right? I have buyers all the time that want to lowball sellers. It's like a practice is listed for $750. They say, Brett, after your analysis, your cash flow, I think $675 will be a good price. Well, good luck. It's a tough market right now to be able to do that. Sometimes you just need to bite the bullet and pay the asking price. If it works out and lines up well with you, it's probably okay. But we do go through those justifications, the reasonableness of the asking price. If it's not way out of range, you know, it's not the end of the day if you're slightly over what a reasonable range would be considered from our standpoint. The incremental cost difference would be about $100 for every $10,000 you go up in price. So that should get you a good idea. There are other negotiation points. You can negotiate with potentially accounts receivable purchases. You can negotiate with the allocation of the purchase price, and we'll talk about that here in a minute. It's not going to be like a huge, it's not going to move the needle too much if you do get some better negotiation on those things, but they can help to offset, you know, some of these other things. And so we're going to let Quentin go through some benchmarks and a few other key points to take into consideration while doing your financial due diligence.
Thanks, Brett. So one item that's Ali was referring to earlier is, you know, it's important to evaluate different components of the practice. And one way you can do that is by, you know, taking what's on the broker's prospectus or the seller's tax returns that you get when you're doing your due diligence. And you can categorize costs into, you know, categories that you can compare, especially with industry averages. So, for example, Ali referred to an instance where, you know, if you see supply costs are low, that would raise a question in your mind saying, well, what's going on here? Maybe there's a deep discount that's been negotiated that you won't get in the future, or that they're sharing expenses between other practices. Or if you categorize expenses in group, what becomes a facilities expense, or which would include rent. If you see that's way above the averages in the industry, that might be an area where you can go back and try to negotiate if the seller also owns the building. So we recommend, when we do our financial analysis, to spend a moment looking at the benchmarks and analyze the financial data to see if there's further questions you can derive from this, or areas that you want to look into further. And the next slide we have, this is an example of a financial statement, a recurring financial statement that we give our clients. We think it's important to, you know, especially when you're beginning to own the practice and throughout your whole career, it's important to constantly evaluate these different areas of costs that you're spending in your practice, just because it'll help you identify the areas where, you know, you might be lagging behind the industry, and might help you focus on what matters the most. The next slide, I'll kind of summarize this. Ali did a good job covering the most important points here. The question came up, what are the tax ramifications of a purchase? From a high level, when you spend money for a business purpose, you get a tax deduction, right? So when you buy a practice, you get a tax deduction. The interesting thing about that when it comes to how the cost of buying a practice is allocated, depending on which bucket it is, whether it's goodwill or equipment, you're able to take that deduction, that tax deduction over a certain amount of time. So, Ali mentioned, goodwill is always the highest asset that gets the most value. For a buyer, you recognize that tax deduction over 15 years. So you don't get to take a huge deduction up front, it gets spread out. Whereas equipment, you could possibly take that deduction all in the first year, or you can spread it out over 5 to 7 years. So, again, just to reaffirm something that was said earlier, this definitely shouldn't be a deal killer. Shouldn't get held up over this matter. Brett and I did a quick calculation, and switching goodwill to equipment, kind of winning on the negotiating side as a buyer would really only save you possibly like $6,000 to $7,000 in taxes in the beginning in the year, but you would still get that same deduction in the future. It's just a matter of timing.
And it was $6,000 a year for the first 5 years. So it was, you get to save $28,000 in the first 5 years of practice ownership, which, that's a pretty good help if you're trying to get things rolling. But if you break it down by year, it's about $6,200 or something a year that you're saving in taxes that are going to impact your cash flow. But at the end of the day, you're still able to write it off, one way or another. It's just a matter of timing.
Perfect. And then just a few last things to consider. When you become a new business owner, there's definitely deductions you should be aware of that will help you save taxes, and you get added benefits by becoming a practice owner. Just to highlight a few real quickly, you can pay rent from your corporation to yourself. For example, if you own your home and you have a board meeting at your own home, you can do that up to like 14 days during the year and pay yourself a daily rent amount for those 14 days. So that's a great tax benefit. We recommend if you're on like a high deductible health plan for insurance, set up a health savings account. That's a tax deduction. Being a practice owner, you can employ your spouse and your children, giving them a relatively reasonable role within the practice. You can justify paying them a salary and getting that deduction. And also setting up a retirement plan. Obviously we go into business, you become a practice owner to make money and work towards retirement, so you don't have to work anymore. So saving for retirement is really important. And the last slide just has different retirement plans that you can set up. And we'd recommend in the first year, it's probably important to stabilize your cash flows and make sure everything's squared away. But once you feel comfortable with the income you're generating, it's definitely a good idea to set up retirement plans, and that's one of the key things we do at Thomas Stahl.
That's all of our information. We'll see if there's any other questions that we need to go through.
How should 2021 impact the valuation of a practice? Does the timing that we're in right now, is that going to affect the valuation of a practice?
Yeah, it certainly can. I mean, it's all over the place right now, right? So a lot of brokers out there are throwing 2020 numbers out the door. And I was looking at a deal just this morning where they basically valued the practice on 2019 numbers. And so I'm like, well, wait a second, what happened in 2021? There was not even a 2021 in the seller's P&L in the seller's packet. So, you got to be really careful about that, because the most recent year is ultimately what's driving the value of the practice. So yeah, with that there are a lot of buyers. I feel like it is still somewhat a seller's market, so to speak. I think the pandemic led a lot of people to retire early, and you kind of think, well, there's a lot more practices going on the market earlier. You'd think that would lower the value of practices, but what I'm seeing, I mean, it really hasn't impacted the values a lot. And I'm not a broker or in a, not like appraising practices necessarily, but that's just kind of what I've seen represented buyers as they go through.
Okay, great. I don't have any other questions.
Taylor has a great, as brokers, we're removing 2020 out of the weighted average calculation, but it still shows in the financials. That's a great comment there. Yeah.
Sounds great. Well, I don't have any more questions. Go ahead, JoAnne.
Well, first, I want to give you a big shout out. Thank you for cooperating with the presentation, helping us recording it. Bill has been my friend for more than 20 years. He's the Senior Vice President of MedChart Digital. And although he's been in marketing and media for many years, his main focus now is internet marketing. He does website design, SEO, PPC. He works with dentists, physicians, and can help you with your marketing. I really appreciate your help.
No, thank you for the plug, JoAnne. Look for an email from us. I'll be recording. I'll have the recording for everybody, and you all have a good evening tonight.
Thank you, everyone.